From first engagement to quiet ownership. Hello, everyone. My name is Tessa, and I'm here to introduce you to Reagan Rodriguez. Reagan is a futurist who teaches stratosphere wealthy legacy families how to become impact investors. Hi, Reagan. How are you today?
I'm going to say 8 out of 10.
Oh, really? That's good. I mean, no,
Yeah,
yeah.
it means there's always room for improvement. But yeah, I'm doing all right, and good topic we're going to go over.
Yes.
So let's just go ahead and get started, right?
Perfect.
Yeah. So today, what I'd like to go over with all of you is the control offer. Yet, what a great title that we just thought of. From first engagement to quiet ownership. That is probably more appropriate. And I also just thought of something else that also I think fits into this. You don't buy businesses, you earn the right to own them. So here's what I'd like you to think about. Think about the initiation. And why do I say that that stage exists? Because by now, something meaningful has probably occurred. And it did, because you've identified that viable target. You've earned a real conversation with now a real owner. So this is why I say that this is where I have noticed that this is where most people fail. And not necessarily because the strategy is complex, but because they misunderstand what they're actually offering. But you're not going to have that issue if you're watching this, okay? Because I'm going to teach you that you're not there to be pitchy. You're also not there to ask for equity, nor are we going to sell ourselves on anything. Instead, we're going to do a controlled solution to an existing problem. And the currency that you are exchanging is certainty. Let me say that again. The currency that you are exchanging is certainty. I want to talk to you also about that core frame. And it's important, if you're writing this down, I want you to write down, do not dilute this. I don't want you to dilute any of this, meaning what I'm about to talk about next, because what you're going to be proposing is going to be very simple, but it must be framed correctly. So here's what you're going to do. You are going to fix structural problem or materially enhance the enterprise value. And by doing that in exchange, you're doing it for an exchange of a monthly retainer and equity participation aligned to that performance. So the unspoken message is, I believe strong enough in the value that I create that I'm willing to take my upside in ownership, not just cash. If you're writing this down, guys, I want you to think of this as kind of that mindset that you want to adapt, that you believe strongly enough in the value that you create that you are willing to take your upside in ownership, not just cash. That sentence, when implied, not spoken, I have noticed is going to separate you from all the other consultants out there or advisors or brokers or what I call joker brokers and or that buyer that does not know what you and I know. Because you're not going to be any of those people. You're not going to be a consultant. You're not going to be a broker. And I don't want you to be that deal junkie person. Let's think of you're an operator entering into a controlled terms. So where does your value come from? Let's talk about that capability. Your value, it's got to be real. The cleanest starting point is always your lived operating experience. So let me give you an example. Maybe you work in finance. Maybe you work in accounting. Maybe you work as a CFO where you oversight, or I think what I'm saying, maybe you have cash flow control, Or maybe you say, look, my background's in sales. I know how to put together pipeline systems. I know how to do conversions. Or I know about team performance. Or maybe your expertise is like yours, Tessa. You're good at marketing. You're good at positioning. You're good at putting together funnels for people like you've done with me. It is digital leverage that you're very good at. Or maybe you're more like me, that procurement is your expertise. So you're going to renegotiate with vendors, suppliers. You're going to reduce costs for them. Or maybe your background is more in operations. You're good at putting together systems with people and then executing on that discipline. This matters because I've noticed that confidence is going to travel fastest when it's earned. You're not speculating here, guys. Remember, you're applying a known edge. Now, I have had people ask me before, well, Reagan, what do I do with my experiences a little bit more broad? I had someone ask me that the other day, and I said, then simply use diagnostics. If your background is more of a generalist, well, my goodness, then don't guess, right? I would never ask you to do that. You're not going to guess. We're going to diagnose. And we're going to do that through structured business assessments. So you're going to establish the current valuation reality. You're all going to establish the operational weaknesses. And then also establish that value leakage points. When you do that output, it's been my experience that basically two things happen at once. You establish credibility, and then it reveals this value gap. And now the conversation is going to shift. You're no longer selling, you're interpreting reality. I want to talk about that value gap because that's going to be your opening. Once that assessment is complete, you're going to show two states, now and after. Now, where the business currently sits, and then after, where it could sit with intervention. Often what I've noticed is that gap is kind of extreme. What I mean by that is it might be a 500,000 enterprise that can frequently support 1.5 to 2 million plus, meaning with targeted changes. So then at that point, you do something counterintuitive. I recommend you give them the roadmap. I want you to explain to them, hey, this is what to fix here. This is why it matters. And what is it worth to you? Mm-hmm. And then you stop talking. Because most owners always know what needs fixing. They just do not want to do it. Or maybe they just can't. So that silence is now going to create leverage. Since we're talking about the control law, I'd like you to think in terms of structure, not sales. So instead, introduce that structure. And I know that when I do it calmly, I do it precisely, and I do it without performance. And the reason why you want to do it that way is the internal logic is this. Ordinarily, this level of involvement is a high daily rate. And instead, I'm willing to work on a reduced monthly retainer and take the majority of my upside in equity because I believe in the value that we can create. I've noticed that when you do that, you're doing three things simultaneously. So again, you're explaining to them that this level of involvement normally is a high hourly rate but you're going to do it at a reduced monthly retainer, and you're going to take the majority of your on equity. And the reason why you're going to do that is because you believe in the value that you create. So what is that going to do? It does three things simultaneously. It reduces the cash restraint from the owner. It's going to align the incentives, and it's going to position you as a partner, not a vendor. Let me also go over what those three equity structures are, and I want you to master these. These are three clean structures. Which one of these that you use, or should I say, I use, it's going to be on trust, psychology, and leverage. Let me move on. The first one is equity issued upfront. This is what I prefer. This is why it's the first one. It's called, if you're writing this down, it's called equity issued upfront, and then in parentheses, put preferred. So that's what I prefer. And here's what it is. It's not either or, it's and. Monthly retainer and 10 to 25% equity issued at signing. Now this works when and only when trust is present and value creation is obvious, and when the owner is decisive. And if you're able to triple the enterprise value, then that's going to be fair. That's win-win. The second one is, write this down, equity kicker, maybe in parentheses put performance-based. So what you're doing, that's when maybe trust is just formed, right? So you're going to attach equity to the delivery. Let me give you an example. Maybe $5,000 per month for 6 months, and 10% equity issued upon hitting certain defined outcomes. If you do that, then the metrics are going to have to be objective. They've got to be on profit, valuation delta, maybe also sales volume, and then the balance sheet improvement. It's still aligned and it's still clean. Let me move on to the third one. Write this down as risk reversal. And sure, since I did parentheses on the other two, we're going to call this advanced. And on the risk reversal, here's what you're going to do. Equity is agreed up front, vesting after delivery, and then the aligns the ownership. So this feels more owner friendly, but let me note on this. Contracts reveal character. This leads to an important hidden advantage. I call it the character test. And yes, most people, they miss this. This engagement is not just about value creation. It is a test of integrity. You're going to observe, do they honor their commitments? Do they act in good faith? Can they be trusted in now larger transactions? I've noticed it's far better to discover this now during that acquisition. Most owners, they do perform honorably. That's been my experience. Okay, they really do. But when they don't, you also learn early. And when I do learn early, I look at that as power. And it is, because I just found something out. Let's talk on authority next. And why this stage is so critical. Because now is going to come that real advantage. During this period, you're going to work inside the business. You're going to execute real changes, and you're going to observe people, systems, and the entire culture. You will understand the business far better than any traditional due diligence process could. And there is no data rooms that provide that kind of clarity. This is what I call embedded due diligence. Let's move on and talk about what that real problem is that you're solving. Because most owners, they want to sell, but they're not able to. Why? Because the accounts are optimized for tax purposes, not profit, or maybe they're personal expenses, or maybe run through the business, or maybe the roles are undocumented and they're just fluid, or maybe the owner dependency is, as you've seen, Tessa, everywhere. You see that in. So, from a buyer's perspective, though, this looks like chaos.
Yeah.
So, that's why most buyers are going to walk away and not acquire the business. I also want to talk about what is a huge opportunity for you. If you're writing this down, that data room, call it the data room gap. Because here's where that huge opportunity is. Most small businesses, they don't have a clean data room. They're not transaction ready. They're misrepresented by the brokers, and that broker signed that business for sale. They don't prepare them to be sold. So what happens as a result, my experience has been that only 1 in 10 of broker listings transact. The rest are just stagnant. So making a business sellable, if you really think about it, you are offering extraordinary value. That 10 to 20% equity is easily justified for this. You do not need to execute everything personally. I want you to remember that. You can leverage through joint ventures, so you can charge the consulting fee, then secure the equity, delegate the execution to specialists, and then let those operators do nothing but build the data rooms, clean the accounts, and document the processes. And when you do that, you simply share a portion of the upside. This way you retain the control. Let me instead close with this. When you are, what you are really selling is not consulting. It is clarity, control, and optionality. You are de-risking their future, and you're making the business legible. You're also creating an exit or an ownership path. And I've noticed that when you do that, the agreement must solve a real problem. It must be something that you can confidently deliver on, and then align equity to the real value creation. You're not asking for equity. You are structuring your way into it. I think I've said enough on this one, Tessa.
This is so much information.
Do you have any comments? And then go ahead and close us out as always. Go ahead. What were you saying?
Yes, no, I was just going to say, I think so much information in here, and thank you very, very much for that. I hope you all took notes like I did. But if you do want to find out more about how to be in the room with Reagan, that's really where the conversations you can go through with people and help them through the idiosyncrasies of building this out. So you can be in the room with the Underground Club. You can find out more about that on the website at Fifth Avenue Capital's website, 5thaavc.com. And fill out the form and get in touch with Reagan. If you haven't already hit the bell to get notifications, you can hit that and see us anytime we go live. Thank you so much. And Reagan, as always, bringing so much information. We'll see you all next